Sean Ashton is well known in the investment community in South Africa. He works with OMBA, which is London-based. He, of course, is based here at home still. But 2 weeks ago, he wrote a very instructive piece that was published on BizNews, which focused on the American stock market, where he highlighted how the big caps had massively outperformed the medium and small caps. And really what that means is that shares in the smaller companies in America have done worse than those in the bigger companies over the last 5 years. Now, we're going to get into that in some detail, talk about the Magnificent Seven and exactly what a big cap and a small cap is, and even the gorilla game, which I'd love to get Sean's views on. But before we go there, it's so interesting, Sean, and we were talking a little off camera a moment ago about how South African investors have kind of discovered that there's a world outside of the JSE. And more people who live in South Africa are now getting that there's an Amazon, an Apple, a Nvidia that they can invest in rather than Barlow's, Anglo American, and Sanlam. This has been quite a rapid transition. It took a long time for that penny to drop, but it's been quite a rapid transition lately.
I'm surprised it's taken as long as it has. I would have thought it would have been obvious as long as 10 years ago, but I think what's happened is the local investors have woken up to just how much damage they've suffered in terms of opportunity cost of investment, certainly over the last couple of years. And perhaps it's through necessity that they're forced to now think about alternatives. But yes, I think one of the issues really is that the local South African market has become very concentrated in terms of, not just concentrated, your investment universe has shrunk. I think liquidity is concentrated in pockets of a handful of large stocks, and outside of that, there's not much that goes on. And if you want global exposure, you're limited to, I don't know, probably 5 stocks, five meaningful stocks that give you exposure outside of just the resources sector. That's not good enough. I think one of the best reasons for looking further afield is that you can find a wealth of different opportunities across many different sectors. It doesn't just have to be one sector.
And it's not just the investors who are getting this. In the past week, Coronation Chief Investment Officer, I think his name is Carl, anyway, I don't remember his surname, but that's him, yeah. He was saying that it's been a lost decade for South African investors. And yet, for most of that past decade, Coronation, Old Mutual, you name it, they were all banging the local is lekker drum. Magnus Haystack must be feeling happy about this. What about you? What has your strategy been in the past 10 years?
Look, I mean, my strategy has been to externalize as much as possible and to focus more on offshore investments. I can't remember the last time I spent much time on an SA stock. It's literally that long ago. So I try and think as a global investor. I don't see myself as a South African investor at all. And I think that doesn't mean that South Africa might go through time periods where it outperforms. I think a lot of the value guys would be banging the drum potentially on South Africa representing a good value opportunity. I think that the problem we face now is that there's a liquidity issue. So for big institutional investors, it's very hard to differentiate outside of the top 40 if you do sit in that camp. How do you add value? Because all of the portfolios will look by and large the same. But secondly, I think that as a country, it looks like we're losing critical mass of everything, of taxpayers, of skilled individuals. It's of infrastructure, even physical infrastructure. So it's very hard for me to paint. I can't make a case for being invested in South Africa. Is the honest truth. That's how I see things.
And when it's such a small part of global,
not until the governing party changes, which I don't bet on that happening. I'm not going to bet my career on that happening.
But it is an interesting point. We've got an election coming up on the 29th of May, and I guess all bets could change after that. But
I'm not going to front run that outcome.
All bets could go the other way. No, but when you then go back into the way that you focused on the international markets, presumably it does give you an advantage to be in this internet age where information is available to everyone virtually simultaneously.
Is that an advantage? You could argue it's a disadvantage for professional investors because it means that the playing field has been leveled, which is great news for individual investors. I think it's become. I think our jobs as professional asset managers are. They've always been tough, but they're getting tougher, and they're the toughest they've ever been. But that's good for savers ultimately because it means that you know the playing field is level, and that's how it should be. You would argue.
On the other hand, most savers have got a day job and they don't have the experience or the balance sheets really to be investing all the time on the international markets.
That's true.
The piece that you wrote 2 weeks ago, maybe we could look at that because a lot of South Africans are heavily invested in the Magnificent Seven, those seven stocks on Wall Street that have made all the running. But being nervous, I mean, we've got Nvidia in the BizNews portfolio. It's now become our biggest stock because it's up 250% in a year. And you got to look at that and say, it's 18% of this model portfolio that we have. Is it time not to become a little cautious and to start looking for where you can get $1 worth of assets for 60 cents in the purchase, rather than paying $1.50 for assets that are worth maybe $1?
I think this brings us into an important discussion, and NVIDIA is a good example to use. And just for the benefit of the listeners or the viewers, the article that we penned was comparing the S&P 400, which is the mid-cap index returns, to the S&P 500. And there's obviously a lot of history, but we spoke about year-to-date numbers where I think as of mid-February, the S&P 500 is up 5.5%, and the 400 is up about 1%. And I'll get into the conversation. But the crux of the article was that when you look through the data of how that performance was made up, you had a significant negative skew in the performance numbers, in the sense that for the S&P 400, median returns were actually negative, minus 1.5%, and the average return of the stock in that index was down 0.3%. Okay, but you were actually slightly positive. So you had a very tiny tail of top performing stocks that delivered all your return. For that index, it was actually Supermicro and Deckers Outdoor. Those were 2% of the index delivering all of the return. For the S&P 500, the median returns were slightly positive, but again, the average return was bigger than the median. So again, you've got the situation of a tail of losers and a very small number of stocks that did very well. But that skew was, you were more skewed in the smaller portfolios, in the mid cap index. So the point I'm making here is that you in these smaller cap indices, you haven't had the opportunity for winners to contribute disproportionately and become a very large part of that index. Because ultimately what happens is, if you have secular outperformers or real winners that are multi-decade winners, eventually those companies become big enough to move on to the S&P 500. The big winners in the S&P 500 don't have anywhere else to go. And that's why you see this issue of, 1/4 of the market cap of the S&P 500 is 5 companies. And when you look at the mid-cap index, that's 5 companies is maybe 4% of the index. And I think the lesson here, and one of the sayings I often hear as it pertains to markets is, well, trees don't grow to the sky. And I think that's a terrible analogy to use as it pertains to equity investments, because returns are not normally distributed. I'll use the example of, let's look at something in nature, like how trees grow. Let's use that same example. There's a tree called Hyperion, which is it's the largest tree on Earth. It's a sequoia in California. The estimates are it's 600 to 800 years old, and it's taken that long to reach 116 meters high, right? As of 2019, I think was the last numbers I saw when I Googled. Now, if we said to ourselves, okay, 10 years ago, I planted a 100 centimeter tall sapling, and it grew at the same pace that NVIDIA's share price has grown in the last 10 years, well, that tree would be 194 meters tall. So almost twice the height of Hyperion that took 800 years to get there. If we look back to 2006 data, And we said, okay, at the same point in time, that same tree that was 115 meters tall at that point in time, if it grew at the same rate as Nvidia's share price, it would be 22 kilometers tall. So, what's this crazy analogy? The point that I'm trying to make here, the point I'm trying to make is that financial markets do not follow nature in terms of distribution of returns and power laws. Returns to scale are a real thing, and your big winners can become outsized contributors, and you need to think very carefully about cutting that stuff back. As you see, as happens in certain indices, market cap weighted indices like the S&P 500 are almost a naturally rebalancing organism where your big winners become disproportionate contributors and your losers eventually get culled. They fall into a lesser index.
That's a fascinating analogy. Sean, just for clarity, the S&P 500 and the S&P 400, and then we'll talk about the Russell 2000 in a moment. Where are the break-off areas? In other words, when do you cut off roughly from the 400 to the 500, just so that we can understand that the one is for big companies?
When I last checked, I think the inclusion data went to about a $13 billion odd market cap for the S&P 400. But of course now its largest constituent, which is Supermicro Computer. Some listeners may have come across this name. The last I checked, it was up 160% year to date. It's been a massive performer. That was like north of $40 billion in market cap. So at some point in time, there are different inclusion criteria like trailing profitability and liquidity. But at some point in time, that stock should leave that index. It can't stay there forever.
But the important thing for South Africans to realize is that by comparison with the South African market, when you talk about $13 billion, that's 200 plus billion rand. Not too many stocks on the JSE would even get to that level. So very few South African companies would be in the S&P 500. So when you're looking for big companies, we just don't have them by that comparison. And that brings me to the next question, which is, but surely this thing called the guerrilla game, and being in the tech industry now for the last 25 years since I moved into the internet, I've become very aware of this, that the bigger you are, the bigger you get. It's like it supports the guerrillas of the industry. Is that not something to bear in mind when one starts looking at the way that the performance of these shares are over time?
Absolutely. And I think that we need to think carefully about whether or not there's been a regime change in the economic structure of financial markets and the economy at large as a result of technology. Because a very interesting point to make is that I talk about large cap indices and large stocks within those indices having outperformed so significantly recently. OMBA's done a study on this. If you look at the long-term history since 1991, the S&P 400 has actually outperformed the S&P 500. So the mid-caps have done better than the S&P 500 over that time frame by a factor of 45% cumulatively. So there's been significant outperformance since the inception of that index. However, all of that outperformance took place prior to 2011. Now, 2011 might just be an arbitrary date, but the point I'm making is that the last 13 odd years, which is a long time. I mean, most investors won't have much more than a 10-year horizon. The last 13 years, you've seen persistent underperformance. So it looks like there could have been a regime change in this secular outperformance of small versus large. And I asked myself the question, is this not because we've, in the world we find ourselves in today, and it's probably been a 20-year story, not necessarily a 10 to 15-year story, but these things take time to evolve. You've had business models that have emerged where they've created winner-take-all or winner-take-most economics via network effects, and scale begets scale, and the strong get stronger, and in many cases they can grow faster as they get bigger. So a good example I would use would be something like Meta and Google together. Those two companies are now half of global advertising revenues. Like, that situation would have been unthinkable in the 1980s and 1990s. It wouldn't have existed, that extent of concentration of economic power. And so I do ask myself, have we had a regime shift? And I think it's possible. So I think these very long-term studies, when you say, well, small caps have outperformed, it may not still apply those same rules because of how economics have shifted in favor of very large corporations gaining economic clout.
The point that you make there is one that is very close to our industry. Well, it's our industry. What has happened in media is that Google and Meta have come along with a vastly superior advertising model because they get given personal information. They can then provide detailed personal information on people at 1/20th of the cost of traditional media. So why wouldn't they?
And they have network effects that the digital business model wouldn't have afforded to a legacy advertising business back in before these companies existed. Another point worth making, and it kind of stays with the NVIDIA theme, is the law of large numbers often says that the bigger you get, the slower you should begin to grow, because eventually you just run into scale issues. And I think for the most part that can be true, but NVIDIA, that's a great example of where, maybe it's the exception, but it's completely broken the rules. NVIDIA is obviously 200 times bigger than it was 10 years ago, but this company is experiencing its fastest ever growth rates in revenue. It's never grown as fast as it's growing today. So despite the increased scale, it's growing faster than it has over its history, which I think is quite interesting. I think the last quarterly numbers are something like 200% year on year, top line.
Extraordinary, 265. Yeah. But Sean, so where do we go now as investors? Because you would be looking at the S&P 400 and the Russell 2000 and saying, hang on, these have underperformed the bigger companies. So that's where we should be putting our money. That would be the classical approach towards it. Is that the way you're looking at it?
Not necessarily. I think it's a case-by-case basis. So, I mean, I'm obviously within the realm of operating within an ETF-driven business. My bread and butter is obviously looking at companies and delving into the detail of each specific investment. So it's very much case-by-case, Alec. I wouldn't say that as a rule I'm culling the winners to try and find smaller stocks that are coming through the ranks. There might be small opportunities that we look at, but it's very case by case. We're not selling out of our semiconductor winners just yet. I think the issue that something like NVIDIA is starting to pose for investors at the moment is, and this is the difficulty here. You now have a very big business. And what we're not sure about is whether or not this represents peak earnings. And interestingly, NVIDIA is actually cheaper than it's been over the last couple of months on the basis of forward PE multiples. But that can also be a sign of saying, well, you're starting to run into peak earnings concerns. People are starting to think about this issue. How much higher can margins go when you're running at a 2/3 operating margin? Not gross margin, operating margin. Like, it's the most profitable it's ever been. We haven't seen companies of this scale with that level of margin. And that tells you just how dominant they are in that space. But I think within that sector specifically, there could be other stocks like we like AMD at the moment. We think that we think that they're probably the most credible second-tier player within data center GPU chips, for example, to drive the AI revolution. But they haven't had their hockey stick curve of increased demand yet into data center supply. I think that's coming. But where's the relative delta from here? Is there more upside for their data center business as a percentage of its current size versus NVIDIA? I'd probably say yes. But you can, we think you can own a basket of these things as well, and they'll still do quite well.
And to close off with the house view, if you heavily invested in the S&P 500, in other words, in the big stocks and the Magnificent Seven, do you stick with it?
I think the house view has been to moderate exposure there, because we've had some trades where we've put on like an equal weighted S&P 500. I think that those types of trades will be tactical though. I don't think that because naturally what you're doing when you're placing an equal weighted index trade on is you're saying we expect some reversion to the mean. And that often does happen in financial markets. You do get reversion to the mean for time periods, but then from that level, you start to see your outperformers and your dispersion coming through in terms of performance and non-normally distributed returns. So I think at points in time that makes sense. But would I back an equal weighted S&P 500 over the next 10 years versus just the straight index? No, that wouldn't be my call.
Sean Ashton is with OMBA, and I'm Alec Hogg from BizNews.com.